circles and never will be. Lots of investors just can't stand the thought of taking the average result. It's only natural to want to beat everyone else, isn't it? People like to win. Navy football coach Eddie Erdelatz said, "A tie is like kissing your sister," after a scoreless tie against Duke in 1953. Lots of people feel that taking the average return is like that. For their part, most Wall Street firms would just as soon have index funds simply go away. There's not much money to be made managing index funds. There's a reason for the old adage that advice about index funds is the best investment advice you'll never get. Critics also say that index funds focus on big firms and therefore lack diversification. That's partly true, but it's also unfair. Index funds are just reflecting the actual market. You can wish that the market wasn't dominated by big firms, but that won't change anything. To illustrate, the S&P 500, which represents about 3/4 of the U.S. stock market's value, it usually has about 1/4 of its market value in just 10 or so firms. The market really is dominated by a few big firms. So if you want to track the market, then your portfolio will be dominated by a few big firms too. Professor Malkiel, an avid supporter of indexing, says, "You can't control what markets can do, but you can control the costs you pay." Of course, no mutual fund is completely free of costs. In fact, mutual funds are subject to several different types of fees. Not all funds have all of these fees, and you should always ask the people at the funds exactly what fees you'll pay. Among the most visible fees are load charges. You pay a front-end load when you buy shares in the fund and a back-end load when you sell them. Back-end loads are often called redemption fees or sometimes a deferred sales charge. It's pretty common for deferred sales charges to decline or vanish if you hold the shares long enough. Personally, I never buy a fund with a load charge unless it'll vanish within a couple of years. That type of load won't hurt investors who hold shares long term. You can make the case that investors who plan to hold the fund for a long time would benefit by paying a relatively large amount up front in exchange for lower annual fees along the way. Put that way, a front-end load charge is a way to attract long-term investors. I'd feel better about that line of reasoning if there weren't no-load funds with annual fees that are just as low as funds with load charges. All funds incur operating expenses too. They pay commissions when they buy or sell shares. They have to pay administrative expenses and overhead. The light bill doesn't pay itself. And the managers have to make a living too. Even index funds incur these costs, although they're lots lower than they are in an actively managed fund. I don't want you to obsess about a particular type of fee. My take is that you can call a fee whatever you want. I want the fund to add up all of those fees, whatever their names, and tell me how much it is as a percentage of assets. All else equal, I want that number to be as low as possible because fees come out of returns. If the fees don't lead to higher returns to cover their costs, then I'd just as soon do without them. Let's get a sense of the size of fund fees. What's a fair comparison? Professor Malkiel says that fees for actively managed funds look small as a percentage of assets. Put that way, total fees average less than 1%. But Malkiel points out that compared to annual stock returns of, say, 6% or 7%, that 1% fee is about 15% of your portfolio return. Malkiel goes even farther. He argues that the correct comparison is between fees and the extra returns that the active managers earn through shrewd investing. If a manager earns an extra 2% by picking the right stocks, then a 1% fee still leaves me 1% ahead. That's a fee I wouldn't mind paying. The trouble is that these extra returns seem to be somewhere between tiny and non-existent.